Portfolio Builder members, what a weekend. President Trump is threatening to rise tariffs to 25% this Friday. This caused a huge sell-off in China, 7% on one of their main indexes down. Their currency is plunging, and so the heat is on. We did go down a little bit. We were at a 7.34% return Friday going into this week. And with the plunge, we did lose about 0.8%. So not a whole lot. And because we do have our covered call protecting us, it's a lot less than most people out there. This does, however, further the case that rates may be decreased, especially if tariffs continue to persist. So we are selling the TBT position, which was a hedge against rising rates, which we may put back on. If the trade deal is coming together, rates need to go back up. But right now, until that cements, we sold the 10% TBT position and rotated into a 5% position into the inverse ETFs. Now, we'll go over exactly how many shares you would purchase if you just wanted to calculate this in your head per contract you're writing on the SPY. Let's just scroll down and look at today's trade alert. The covered call, we can close for a 98% profit, buy it back for a penny. The new covered call is still relatively bullish. Even though the market had a sell-off in the futures market, it is reacting very bullishly today. So we're writing the 294 sell to open May 8th, 2019 covered call. For every 100 shares of the SPY you own, you can sell to open one of these contracts and collect $42. Plus, if the market does rally up significantly between now and Wednesday, we're essentially agreeing to sell our shares for a price of $294 per share. Right now, SPY is trading at $291.48. So we stand to make an extra $2.50 on top of that 42 cents if we were assigned. Now that's highly unlikely. Most likely we'll get to enjoy most of the profits on the covered call and just hold on to our asset. And that's the name of the game when we're playing the bank and letting the speculators speculate. We own the asset long term, and we let them speculate in these short periods of time. Now if we look at the option volume, it's been pretty fascinating to watch. We have two main things to look at. The put options are on the right side, and the volume is definitely interesting, but that was flowing in and out. What's more interesting right now is where you see volume and a build-up of open interest. So just because there's a ton of volume doesn't matter unless those contracts are staying open, and that's a better indicator for us. So this is the ETF SPY option chain. And on the left, we have the call option data, which is where people are agreeing to sell their shares. And on the right, we have the put option contracts, where option writers are agreeing to buy shares. And what's interesting is the big buildup on the put option side is we have a lot of people willing to purchase shares at $292 with 7,800 shares or contracts open right now. And then just slightly above that, we have a lot of investors willing to sell up in the 294 to 295 range. So we went ahead with the 294 strike. Now, you may not get the exact same price. That's okay. The strike and the date is what you need to pay attention to. The credit you get will be the fair market value at that time. If the SPY goes up, you'll make a little bit more. If the SPY goes down, you'll make a little bit less. The further away the underlying asset is from the strike price, the cheaper it gets when we're writing covered calls. Now, it is important to note that we did sell our TBT hedge for a small loss of about $1.69 per share. And it was a small loss in the portfolio, which we'd already had realized or had unrealized results up here, so it didn't affect our return on investment. We're just out of that position now. I've optimized the portfolio to be 95% SPY with a 5% inverse ETF position. So for every $30,000, that means you would currently invest $1,500, 1,500 into these inverse ETFs. One is for tech and one is for the banking sector, which are two of the bigger positions in the SPY, and also helps sync up with our diamond program. So it's a good hedge if you're just trading the SPY, but if you're in the diamond program and you also have these stocks, which are actually outperforming the SPY today, which is remarkable. But so that's $1,500 for every 30,000 you have invested in the SPY. So that would mean you would purchase 56 shares of TECS per SPY contract you have, and 93 of FAS. If you want to make your life simple, just get 50 of TECs and 100 of FAS. You will have a 5% hedge. This is going to be a slow bleed position, folks. We are going to expect to lose on our hedge until another spike occurs, and that may not happen anytime soon. So here's a look at the TECS. You can see it's plummeted since December's crash from 35 to as low as 12. And if we break into new highs and trade deal resolves, I suspect this could go as low as 6. Same thing over here with FAS, same shape, same sort of story going on. This is just the triple inverse on the financial bear. So as you can see, I'm very hesitant to put much money into that. That is 5%. The worst case scenario on that hedge is perhaps we lose half of it. And I do expect to get out of that far quicker if we see that there is a resolution to this tariff dispute. So hopefully, in the worst case scenario, we might lose a percentage point or two if we're wrong and stocks continue to go up. Now, we will offset that because 95% of our portfolio currently holds a SPY. And I would like to be writing that in the money covered call, but right now, market's just saying to hold off on that. They are betting up still. So we're using the 5% hedge to protect us from the downside. And then we're using the SPY ETF plus the covered call to offset those short-term losses that I'm expecting from our hedge. Now, if we do get some sort of crazy sudden pullback in the SPY this week, do expect to start issuing even more defensive strategies. So if we see things are escalating, I might jump up to the 10% mark on the hedge and start writing the covered call around $5 to $10 in the money, depending on what the market will give us for free. So we'll talk about that more on the webinar tomorrow. For now, the market is still bullish, which is crazy. I just think back to the government shutdown. We know how stubborn Trump can be. Will the Chinese give in and make a deal? Or is this going to escalate? Nobody knows. Nobody knows right now. The market's bullish. So we're going with the momentum of the market. And this little jump in volatility is actually very good for our strategy. It makes our option premium get more and more expensive. So thanks for your time. Don't forget we have a live webinar tomorrow at 1 Eastern, which you will get an email and text message notification if you're on our text message alerts. So thanks again, and looking forward to speaking to you guys live tomorrow.